Hello, and welcome back to the channel. Today we are discussing a practical example of a business combination accounting that you can use either for your studies, ACCA, CPA, or whatever, or if you're working to prepare consolidated financial statements. This is in response to a comment that we received prior, requesting for such practical discussions on the different journal entries required when undergoing a business combination. We have already posted one video, so we link them above, about some variation of this topic. Right now, we will discuss a comprehensive example that covers still goodwill, step acquisition, PPA fair value adjustments, deferred tax adjustments on the purchase price allocation. This one was not covered before. NCI, or non-controlling interest at proportionate value. Previously, we discussed NCI at fair value, so this one is a different case and still a multi-year consolidation so that you can see what are the impacts of all of these adjustments on the different periods of the consolidation. Basically, we will not be discussing here so much of the theories, but we will be delving straight into the problem. So if you're new here, don't forget to subscribe so you never miss out on any new video. Let's start. So we will discuss the problem right now, but we will also be posting them into the description so that you can copy paste them easily if you are trying to follow the discussion. So on April 1, year X, Alpha Corp as the parent acquired an additional 50% ownership interest in Beta Limited, the acquiring. It increased the total ownership from 30% to 80%, thereby obtaining control over Beta. The consideration paid for this 50% acquisition was 5 million in cash. So we stop right here. Basically, this is what we mean with step acquisition. It means that we already have a previously held interest that are accounted for differently. We still don't have control. In this case, it's 30%. We assume that it's significant influence. So before we don't have control, we acquired 50% more. So now we have control. So this is what we call as the step acquisition. Prior to the acquisition, Alpha Corp held 30% interest in Beta, which was accounted for using the equity method because associates are accounted for at equity method. On April 1, year X, the fair value of Beta Limited's 100% equity was determined to be 9.5 million. So this is going to be relevant in the computation of the fair value of the previously held interest. A fair value assessment as at April 1 of Beta Limited's here net assets identified the following differences. So what happens during a business combination transaction is that the parent would like to buy a subsidiary, the shares of the subsidiary to obtain control. So one of the requirements to be able to complete the purchase transaction is to have a fair valuation of the net assets that they're acquiring. So of course, if you're buying something, you would like to check what is the value, the fair value of the assets that you are acquiring. In this case, what is the fair value of the company? So here, the fair value of the 9.5 million refers to the equity. So let's assume, for example, that Beta Limited was listed. So the equity of Beta Limited is valued as 9.5 million. But this is different on the fair value of the different assets and liabilities that are inside the balance sheet of Beta. So here we're saying that upon this exercise, the PPE, here it's 4 million PPE net. The PPE had a fair value that was 600,000 higher than its book value. Remaining life of the PPE is 5 years. So in this case, instead of 4 million, we're saying that the fair value is actually 4.6. And the external debt had a fair value that was 250,000 higher than its book value. The debt will mature in 10 years. So here in this case, we have the external debt of 6.5 million. It means that the fair value of the debt is 6,750. So this is one of the things that you have to consider in IFRS 3, the business combination, the standard covering business combination. You have to do a fair value of all the assets and liabilities, even though normally these line items are not normally fair valued in the normal accounting. Because, for example, external debt under IFRS 9 would be measured normally as amortized cost, especially if it's an external debt and it's not a listed security. So here, even though it's like that, we have to do a fair valuation of the external debt still. So Next is the company is subject to the income tax of 20%. So if you see this in a problem in an exam, it means that they're implying that you have to compute the deferred tax component of the PPA adjustments. You see that the company already has deferred tax liability of 250,000. Means that the underlying assets and liabilities of the company, they are already computing deferred taxes. And now you have to compute deferred tax on top of all of this. Basically, under IFRS 3, it's saying that the deferred tax should be computed again. However, in the normal approach that we have in problems and in real life, since the deferred tax liability on the book values have already been computed, you can compute the deferred tax on top of just the purchase price allocation, the PPA adjustments. And lastly, we are talking about here that the NCI in beta, the 20% basically, NCI is 20% because we have a total ownership now of 80% after the step acquisition. The 20% is to be measured at proportionate share of beta's net assets at the time of acquisition. This is supposed to be at fair value. So before the previous example, the previous video, we used fair value of the NCI, which is this 9.5 million. But now it's a bit more complicated, which I think this is a case that you should be learning because this is the most common way in problems and also in practical scenarios. So we have also here the balance sheet of both companies, the parent and then the acquiring. So it's good to examine them to be able to see what are the things that you should be adjusting. So let's examine them a little bit. For the parent, you see that there's cash. So the 5 million that they're going to pay will come from this cash. Then we have investments in beta. This is the original 30%. It's valued at 2.4 million. It's using the equity method. However, you have to remember that for the acquisition transaction, we have to remeasure this at fair value. So that's why this one comes in handy. You have to check how much is the fair value of the equity, how much is the fair value of the previously held interest. So it's 30% of this amount. And normally that's the only case relevant for the parent because the parent normally just gives off resources to effect the business combination. The more important part is to examine the acquiree. For example, here the acquiree, we see that the share capital and retained earnings are 7 million. This is the net assets. If you add the total assets less liabilities, so it adds up to 7 million. And then you see here that we have to adjust this 4 million by 600, this 6.5 million of external debt by 250K. And then we have to consider on top of it additional deferred taxes. Also, you have to notice that there's no P&L of beta, there's no net income of beta, simply because at the time of acquisition, this is April 1. At the time of acquisition, there shouldn't be any net income coming from the acquiree because it is a fresh start for the parent. The parent acquires net assets, balance sheet. The parent acquires the balance sheet. The net income of beta, since they're already operating before, should be close to the retained earnings. So we assume here that all of the net income of beta is already inside this 3 million up to March 31. So these are the most important things you have to consider. By looking at this, you can already have some idea on what to do. Okay. So what are the different consolidation time frames that we have? For me, there are 3 periods that you have to consider. Number 1 is the acquisition date. The acquisition date is when you determine the purchase price allocation. All of the journal entries at the beginning of the business combination is determined at the acquisition date. And here it's in the middle because the acquisition date is not always in the beginning or the end of the year. Normally you have to consider that it happens at the middle of the year, and it has great impact on the amortization later of the PPA adjustments. And then the next one would be the first year end and then the subsequent year ends. Then we will also look at them later. But right now we will look at the acquisition date. So we will look at what we need to do during the acquisition date. What are the journal entries that we need to post? We will focus on that. So we will discuss during the acquisition date accounting, the number 1 thing that you have to do is the purchase price allocation. As discussed before, The purchase price allocation literally means that you are allocating the purchase price, the price that you have paid to acquire the subsidiary. You have to allocate them to the net assets that you have acquired from the subsidiary, and any excess you allocate them to goodwill or to the gain on bargain purchase depending on the result of the PPA computation. So in this case, we need to perform the purchase price allocation. However, the first thing that you need to do before the purchase price allocation is determine how do you value the non-controlling interest. Because previously, in the previous example, if you watched it, we value the non-controlling interest at fair value. And the fair value of the NCI is very easy to compute. It's just this 9.5 million times 30%. You see? However, right now we are valuing interest at proportionate share. So there is a step before we do the actual purchase price allocation because we need this input to be able to complete the purchase price allocation later. So now we have to compute the proportionate share of the NCI on the fair value of the net assets and liabilities of the acquiring. So we cannot just do 20% of this because of all of these adjustments. So we have to first effect this to get the fair value of beta and then get 20% of it. Okay, so initial NCI computation. The net asset of beta is 7 million. So the 7 million is basically composed of the net assets of 15.5 minus all the liabilities. Or easily, it can be the share capital plus retained earnings because assets minus is equal to liabilities plus equity, or assets minus liabilities is equal to equity. So both sides of the same coin. So you have to add all the PPA fair value adjustments. So in this case, we increase it, the 7 million here, we have to increase it by 600 because it was mentioned here. And we also have to decrease it by 250. A decrease because we say that the external debt should be valued higher, and a higher debt would reduce the net asset. And then also, we have the deferred tax impact of 70. This is a deferred tax liability because what happens here is that since the PPE increased in value, basically, under the IAS 12, if the book value of an asset is higher than the tax value of the asset, then there is a deferred tax liability. It is higher by 600 because this fair valuation doesn't really go to the tax books. The tax authorities really doesn't care about the 600. So 20% of this 600 difference between the accounting book value and the tax book value is a deferred tax liability. And it is actually an opposite impact for liabilities. If the book value of a liability is higher than the tax books, in this case, it is higher by 250 because the tax authorities do not care about the 250. This 250 increase came from a business combination transaction. So we have a deferred tax asset. So we have to net 120 deferred tax liability, 50 deferred tax asset. So we have a net deferred tax liability of 70. So if you add all of this together, you will have 7,280,000. So this is now the fair value of beta that we acquired. However, you have to remember that the fair value of beta that we acquired in full is 7,280. It is split between the acquisition made by the parent, Alpha Corp, at 5 million. We acquired 80%. So we own 80% of it. And 20% belongs to the non-controlling interest. So this is what we computed here. So 7,280 times 20% is 1.456 million. So now this is what we will use in the purchase price allocation. So you will see here later that it will actually be a little bit easier once you compute the initial NCI. So basically we will get back to this table. This is a little bit advanced. We will discuss this once we have done the purchase price allocation because this is already with the goodwill. This should have been on the next slide actually. So right here, what is the purchase price allocation? What do we mean? So at least they're both here, so it's good. So what do we have here? The purchase price allocation basically is this part right here. Basically, according to IFRS 3 or the IFRS, you need to allocate the purchase price that you have received and the total consideration that you have, the total sort of the value that went out of the business, including the NCI, is composed of three things. Number one, the fair value of the consideration that you have transferred. So here we have 5 million, which is cash. Actually, you have to consider here the fair value of any liabilities that you have incurred. But here we don't have any because we paid all of them in cash. Then we have the fair value of in previously held interest. Here you see that it's 2.850 million. We have already discussed this. It's going to be 30% of 9.5 million. We don't consider the book value. If we go back, we don't consider this 2.4 million because this is not at fair value. So we have to consider the fair value of the previously held interest, because that's what the standard is saying. We have to remeasure any previously held interest at fair value before we do the purchase price allocation. And then now the NCI at proportionate share 1456. So that's why you see that it's very important that to do this computation first before you do this, because then you will be going back to you will say that, okay, how much is my NCI? Okay, so the total consideration is 9.306 million. And then you're saying that how much did I actually acquire from the acquiring? And that is what we call as the fair value of the identifiable assets and liabilities of the acquiring. So the fair value of the identifiable assets and liabilities is actually what you already computed here in the NCI computation. You see 7 to 80, here it's 7 to 80. So we have the current balance sheet of 7 million as what we discussed before, and you adjust them with all of the PPA adjustments that you have, including the additional deferred tax liability. And then any excess between the two, if it's positive, if the consideration that you have above is higher than the net assets that you acquired, that is what we call as the goodwill. So if it is lower, that is what we call as the gain on bargain purchase. We will do that in another case. Here it's higher, so it's goodwill. It means that even though you acquired, so this is what we're saying, assuming that there's no NCI, we're saying that we acquired assets that are worth 7.2 million. Knowing that, you still paid 9 million. So the excess is what we call goodwill, because this is the excess consideration that you have paid in order to acquire the acquiring, knowing that the fair value is actually lower, so that's why you have to put them in the balance sheet, because this is sort of the additional value you're seeing on the acquiring. If it is a negative amount, it's not a liability, it's going to be like a net credit. You have to put it in the P&L. It's called gain on bargain purchase. We'll discuss that later. So here you will see here that this is still the same computation. These two are the same computation. You see 9306, 9306, and then 7280. So this is just showing that when the NCI is measured at proportionate share here, not at fair value, the goodwill that we have purely belongs to the parent. Before, if you recall, if you look at the other example, the goodwill is shared between NCI and the parent because the NCI is measured at fair value. This one right here is higher because we computed 9.5 times 20%. 9.5 times 20%. But now they're both the same because the proportionate share NCI is equal to the proportionate share at the fair value of the assets and liabilities of the acquiree. So there's actually no excess at the NCI side. The parent shoulders all of the goodwill. So this is a very good difference. If your professors or someone asks you, what is the difference, normally the impact between measuring the NCI at fair value or at proportionate share, the main difference is that the NCI doesn't share in the goodwill if it is on the proportionate share. So now that we have discussed the PPA, the purchase price allocation, the next thing that you need to do is to now prepare the journal entry of the business combination. The journal entry will be essentially coming from the PPA, from the purchase price allocation. And there are two types of journal entries that I would like you to learn because it depends on how you effect the business combination. So basically, the first type of journal entry that we will discuss is the longer version. So you will see here that this is a big journal entry, a compound entry. So there's a first part, second part, third part, and fourth part that I would like to show you. So the first debits and credits that we have are the basic assets and liabilities of the acquiree, because this is a journal entry wherein it starts at the parent level balance sheet, and then we are going to put an entry to put all of the assets and liabilities of the acquiree into the parent. So this is the most common one in school, actually in universities, I would say. So it's very important that you learn how to understand this type of journal entry. So all of this, that we recognize all of the assets as debit and all of the liabilities as credit, because we're going to say that, okay, we're recognizing all of them at book value, or at as it is right now. And then also, there's a portion here to understand where it is in the PPA, because I was saying before that the PPA actually is already your journal entry. If you know that, then it's going to be very easy. Look here, 7 million. The net here is 7 million. Debit minus credit, it was going to be 7 million. The next portion of the journal entry are all of the PPA adjustments. So all of this here is just reflected here. Increase in PPE, it's right here. Debit, increase in liability to 50 credit, additional deferred tax liability of 70 right here. So now we completed the fair value of the assets and liabilities of the acquiree. So all of this above are fair value of the assets and liabilities. And then now we have to put in the journal entry all of this above. So as you can see, here we credited cash. Here we credited the cash account. We credited the 2850 investment in beta. You see here it's 2.4 million. We're going to show you that we need to adjust it later. I'm going to show the journal entry. And then also we have to recognize the NCI. So all of these three is also this one. All of them are credit because it's sort of a value that goes out of the business. You give away a cash, you give away your investment, previously held interest, and then you also give away, portion of the value of the acquiring. You give it to the NCI because you don't own everything. And then lastly, all of this difference here, the purchase price and the PPA, goes to goodwill. So you see, all of this here went to into the journal entry, and it's very easy to do the journal entry once you do the PPA. So basically, the second type of journal entry that I would like to show you is shorter one, but it is essentially the same. The only difference is actually in the first part, where we show the net assets of the book value of the net assets of the fair value of the net assets of the subsidiary, of the new subsidiary. So before this 7,000 is broken down into all of this assets and liabilities. But here we're putting it as the equity side, this 4 and 7K. So it's going to be the same impact, but you will see later how it is being used differently in practice. This one is the one I use more frequently because it is more practical. Because normally you obtain different TBs, trial balances, and then you just effect the business combination entries. You don't always have to reinstate all the original balances, just like the previous entry. This one, it's very useful to know it for university purposes, for ACCA, but this one is the one that you use for practical purposes. So everything else is the same apart from this first part, recognizing the equity directly. So you see it's a debit because it's derecognizing actually the equity. So you were removing the equity of the subsidiary, because this one is a credit, normal balance, and then we debit them. And then everything else is just the same that we have already discussed. And then you have the same goodwill. You see, once you have the PPA, the purchase price allocation, doing the journal entry in whatever type you need to do, you need to understand, it's going to be very easy. I hope that's clear. Because we will now be moving into the actual consolidation. Because here, since I already discussed the journal entry, we will just be showing how it is done. So for the method 1, the type 1 journal entry that I showed you, it starts at the balance sheet of the parent company. So here we laid it out, the balance sheet of the parent company. The first adjustment that we need to do is to bring the previously held interest into fair value. So as what we mentioned before, the previously held interest fair value is the 9.5 million times 30%. It's 2,850. So there's a difference of 450. According to IFRS 3, you need to record this in the P&L, in the profit and loss statement, in the net income. So here, our journal entry is debit investment beta, we increase it, credit income from investments 450. So you see here, we have a 450 increase. So now it's to 850. It's now in line to our purchase price allocation. And then our net income current year increased by 450. So you see here, there's also an adjustment. So from 1,100,000 losses, it increased by 450. Now we have 650,000 of losses at the level of the parent. Okay, so now that we have posted the journal entry to make the investment in Beta Limited, the acquiring, at fair value of 2.850 million, we are now ready to effect the actual business combination journal entry that we have posted, that we have discussed before. Because now we can already use this PPA adjustment wherein the fair value of the interest held is 2.8 million. You will notice that there is no, we don't add here the Beta Limited's balance sheet, because the journal entry actually includes the balance sheet of Beta Limited. That is the beauty of this journal entry. It actually is very intuitive. We have Alpha Corporation, they acquire Beta Limited, so we post this journal entry to effect the acquisition. We also need to effect here the increase of all the line by line assets and liabilities that you acquired from Beta. So it's going to look like this. So as what you can see here, this is the business combination. This is actually the journal entry that what we have here. Exactly. So the net effect for each line item. For example, the cash decreased by 2.5 million. So if the cash decreased by 2.5 million because we paid 5 million to effect the business combination right here, but we received 2.5 million from Beta. This is the cash of Beta itself, So we also recognize here the goodwill of 2 million, right here, 2.026 million. And also, you see that there's no P&L impact because, as what we have mentioned before, the business combination, if it has a goodwill impact, it only impacts the balance sheet. So you see here that we increased the NCI because there's a credit of NCI right here. And then all of the items here are consistent with the journal entry. You will see as well that the share capital and retained earnings at the date of the business combination are coming from the parent only. There's no impact of Beta Limited. So actually that's it. As what you can see, it's very intuitive, it's very easy. As long as you understand how to create the journal entry from the purchase price allocation, and then underlying that, you know how to compute the NCI at proportionate share, then you are actually good to go at the date of acquisition. So now we're going to discuss the other journal entry, because probably you will be able to see the beauty of it, So now, this is still acquisition date console, but this is type 2 journal entry, the method 2, the shorter journal entry that we have discussed before. So, what do we have here? We start with the same thing that we discussed before to bring the investment in Beta Limited at fair value. So I'm not going to repeat it. So it's still the same journal entry. So the goal here is to make the Alpha Corp ready for the PPA by remeasuring the previously held interest at fair value. So now the next step in the journal entry type 2 is actually lay out the Beta Limited books. So these are the books of Beta Limited before any purchase price allocation adjustment. We didn't do anything. We just put them side by side. Because normally this is how you do it in practice. You put all of the entities you want to consolidate and add them together, and then post all of the consolidation journal entries. So in this case, I will just remove these first two columns. So here it's just these two, So in the balance sheet of these two, we only have 2,850. We already have the PPA at 200, the previously held interest at 2,850. So it's ready for the purchase price allocation. And then we just have to post this short journal entry that we have posted before. You see? is very easy to understand, because here in the business combination is very simple. You see that you will see the story of the business combination. The cash was reduced by 5 million because we actually paid, this is the amount that we paid. And then from the data that we have to increase the PPE by 600. We have to affect the goodwill of 2 million. We have to increase the external debt, and we have to recognize additional deferred tax liability. So you see, it's very, for me, it's easier to understand this way, because you're adding the beta limited, and then you're adding the, the additional information that you have from the business combination. And then you see here that we debit 4 million and 3 million share capital and retained earnings coming from the beta, because as what I mentioned to you, the consolidated financial statements of Alpha should be at the perspective of Alpha. So the share capital and retained earnings should be coming only from Alpha. So we have to cancel the impact of this. And that's it. Actually, you will see that whatever you did here is exactly the same as the type 1 journal entry. There is really no difference. We just started off with a different column, because previously we started with just alpha. We posted everything here at the same time, these two columns at the same time, and then we ended up with this. In this second type of journal entry, we posted alpha and beta side by side, and we affected the business combination. So you actually have two choices. So that's the acquisition date consolidation. So once you have done that, all of the adjustments you posted at the acquisition date remain there forever, unless there's of course changes in structure. But if there are no changes in structure, all of them should stay there. And then in the first year end, in the first consolidation year end that you have, what you need to follow are just the purchase price, the amortization of the purchase price allocation adjustments, specifically for the PPE, for the external debt, and for the deferred tax. So let's take a look at it. So the following are the balance sheet and income statements of the parent and the acquiree as of December 3. This is December 31, year X. So this is the first year end. The first year end after the acquisition date. So this is a different balance sheet we have seen before. This is December 31 already. The first balance sheet we saw is at April, So this is like 9 months after that. So what you can see here, the investment in beta limited is already at 80%. It's very good. It's already 7,850. This 7,850 is composed of two things. Number one, the 5 million that they paid on the business combination, and also number two, the 2,850 fair value of the previously held interest. So that is very important to understand, because now at the first year end, we don't have to do the adjustment to bring the fair value, to bring the previously held interest at fair value, because it's already here. We already posted it last April. So now we have to worry about, the continuing journal entries, the other journal entries. Now it's also good to know that we now have P&L of the beta, because as what you can see, we have to record the income and expenses of the acquiree from the date of the business combination. So the business combination date was April. So now all of the income and expenses earned by the subsidiary after April 1 now belongs to the parent. That's why we now have to consolidate them. And that's it actually for the peculiar information on the balance sheet. It's good to examine things before you effect any adjustments, like see if the data are still consistent with your understanding. So now let's do the business combination. We will do just the type 2 journal entry, just for simplicity. So now the type 2 journal entry, you see we have to lay down the two balance sheets for alpha and beta. So normally we have to add them together to be able to show you the balances before consolidation. And then now we have to impact here the business combination adjustment. So this is the basic business combination adjustment, and this is exactly what we posted at the acquisition date. No changes at all. You see here. So except for the cash, actually, because here we don't anymore affect the cash because the cash is already at the level here. So the goal is to remove the investment in beta here. So we still have the same goodwill. Okay. And then the most important thing that actually I would like to discuss with you and to show you is the amortization of the purchase price allocation adjustments. So you will see you can pause the screen to be able to follow the computation. But basically the idea is that all of the PPA adjustment that you posted here should be amortized. Should be amortized based on the data that you have on the problem. For example, for the PPE, we say that the PPE's fair value is higher by 600,000. So that 600,000 is amortized on the remaining life of the PPE. Like for example here, is amortized by 90. 90 is 600 divided by 5 years, which is 100, is 5 years. And that is the annual. And then that annual is still prorated by 9 months. Okay, because it's from April 1. April, May, June, July, August, September, October, November, December. Yeah, it's 9 months. So you have to do this in all of the cut-offs after the acquisition date. You have to amortize because after 5 years, the PPE will be fully depreciated, and then you will also fully depreciate all of the PPA adjustments that you did. So all of them will be zero. If you don't do this, your PPE will be zero and you still have purchase price adjustments remaining in the consolidated financial statement. So it will be wrong. That goes through with the external debt as well. So the external debt, I think, has 10 years of maturity. So you have to amortize the 250 by 10 for the annual times 9 divided by 12 for the 9 months from April. And also, you also have to compute the amortization of the deferred taxes. So you also have here the deferred tax impact of both of this at 20% should also be booked. So you really have to remember that it's a amortization of PPA adjustment or decrease. The 70 is decreased by 14. So after all of the amortizations are done, the DTA should also have zero. Will have zero impact in the balance sheet after all of the years, after 10 years actually for the debt. So all of them will impact the P&L. So these are the journal entries. For example, for the PPE, it impacts depreciation expense. It is shown as an additional depreciation, where the external debt is shown as an additional interest, and the deferred tax liability is shown as a reduction of the deferred tax expense. And actually, we have to book the NCI share in net income. The NCI share in net income happens because we don't fully own the subsidiary. So this net income of the subsidiary is what we can see here is 1 million. We're saying that we don't really own all of this 1 million. The 1 million is split between the parent and the non-controlling interest. However, it's very tricky. You have to consider all of the PPA adjustments because all of these adjustments right here impact the net assets of beta. So you have to add them all together and then compute the share of the NCI. That's why here we have the computation 1 million here plus all of the fair value adjustments and then the deferred tax impact. The total net income to allocate is 943 because it's all of this here. So you have to make sure that you include in the computation all of the net income in the PPA fair value adjustments. You multiply them by 20% and that's the NCI share. You can see here, this is the total net income right here. And then the total net income will still be the same, but we remove a part of it and put them to the non-controlling interest. It's also the same as what we have here. Net income, we reduce it and then we put it to the NCI. And after you add all of that, that will be the consolidated financial statements for December 31 year X, the first year end after the acquisition. So it's good to examine the balance sheet just to ensure that everything is fine. So you see here that there is still no investment in beta because we already eliminated them from the consolidation. The goodwill is the same. That's very important. And you have to make sure that the PPA fair value adjustments are being amortized properly. And then if you check here the equity, you will see that the share capital is still 12 million and the retained earnings are still 5 million because this is the first year end. You see, in the first year end, also in all subsequent year ends, you have to make sure to post the original PPA adjustment. The original PPA adjustments includes the original goodwill of 2 million. You have to adjust the amortization of the PPA adjustments. Any increase in the assets and liabilities, you have to amortize them if they are allowed to be amortized. And you have to consider the deferred tax impact. And lastly, the NCI share in the net income if you have an NCI. By the way, the NCI can only be measured at proportionate share subsequently. The fair value option is only available at the acquisition date. And then lastly, for the subsequent year ends, there's really nothing much to explain. This is not the same trial balance. Oh, this is the same trial balance or consolidation last year. I would just like to emphasize that for subsequent year consolidations, you just have to repeat what you did on these portions. So again, this is still December 31. I did not create any more like year Y, for example, but just to give you some idea that everything should be the same except for this, all of this portion here. Just have to continue the amortization. Now it's 1 year amortization because it's a full year. Previously it's 9 months. You have to prorate them. And now it's 1 year. And basically that's it. Hopefully you learned something new from this discussion. It's a bit long, but you can skip to the lessons, to the portions that you would like to learn, So yeah, that's it. Thank you.